Hello everyone. In today's video, we are going to go over discount and premium, which is an important market mover. The concept of premium and discounts determine whether the market is going to be bullish or bearish. However, to fully understand this concept of discount and premium, you must first understand the concept of liquidity, both buy side and sell side liquidity. I am, however, going to have a brief discussion about liquidity in this video. So I suggest that before watching this video, you go and watch my liquidity video, which is available in my YouTube channel. Right? Moving forward, let's talk about liquidity for a bit. What is liquidity? I like to explain liquidity as the engine that runs the market, in that the market is attracted to liquidity pools in the market. In simple terms, liquidity is found below every swing low or above every swing high. So above every swing high here, there's liquidity. Above every swing high, there's liquidity. Above every swing low, there's liquidity. Above every swing low, there's liquidity. You understand that? Above every swing high, there's liquidity, and above every swing low, there's liquidity. We have liquidity here because retail trading concept teaches us that whenever you want to go long, whenever you want to buy the market here, retail concept teaches us that you must put your stop loss below this low. Your stop loss must be below this low. And whenever you want to sell this market here, your stop loss must be above this high. So your stop loss becomes liquidity. This becomes your buy side liquidity. Your stop loss here becomes your buy side liquidity, and your stop loss here becomes your sell side liquidity. Right? And the market is attracted to that. At some point, the market is going to come and run over this liquidity. Right? That's a brief overview of what liquidity is. Go and watch my liquidity video and come back and watch this video and finish with this year. Now carrying on to discount and premium. What you will look for is a dominant swing. Is a dominant swing or a dominant leg or a dominant displacement. What do I mean by displacement? If you look at the example and on your screen, you look from this high to this low. This is a displacement. This is a displacement, and you're gonna look for the high of the displacement and the low of the displacement. Then you're gonna put on your fib here. You are going to put your fib here. The concept of discount and premium is very easy because whenever you see this, you know this 0.5% is your equilibrium, meaning that the middle part. Then everything below there, the 0.5 is a discount, and everything above the 0.5 is a premium market. So down here we have a discount market, and up here we have a premium market. Okay, now this is important to us because depending on the direction of the market, price will move from premium to discount or from discount to premium. And this is important to us because now we know that for us to catch high probability trades, we need to sell in a premium market and buy in a discounted market. Okay, what that means is you have this leg high here and you have this swing low here. You take your fib and you put from the swing high to the swing low. Everything above the 0.5% is a premium market. That's where you need to sell because we were trying to get to this higher time frame PD array here. So what you look for is you look for a PD array in a premium market. A PD array can be in the form of a fair value gap, can be in the form of a fair value gap. You look at the fair value gap and sell at the fair value gap, or it can be in the form of an order block, not an order block, a breaker block, can be in the form of a breaker block, or even an order block. You can be in the form of an order block. So you sell at the order block and you target this higher time from PD array. Let's say here you have a PD array here. It's a fair value gap. You sell in the fair value gap. The market makes this low. Then you have another leg extension. That means you have to look for your premium market again. You take your fib, you put it to your swing high and to your swing low. Then you look at the market in the premium market. Then you look at what are the PD arrays that we have there. This time you may have an order block. You may have an order block here, and you sell when the market hits the order block, right? So this is an example of a bearish move. So the same thing happens when you hit a higher time frame PD array. So when we hit the higher time frame PD array, we are no longer looking for sell. That means we are looking for buy. We are looking for the market to now go up, meaning that now we are buying. Where do we buy? We buy in a discounted market because we have to buy when the market is cheap and sell when it's expensive. Premium means expensive, discount means cheap. So we've hit the higher time frame PD array. Now we have put this swing low. Now we have this swing high. Then you put your flip here. Where did the market come? The market came to the discounted market. Came to the discounted market. What do you do with that? You look for a PD array in this discounted market in the form of a breaker, order block, or a fair value gap. Let's say you have a fair value gap, then you buy at the fair value gap in the premium market. Then the market bought here, broke this high with a break of structure or change of character. Then we have another leg up. You put your fib here. You put your fib here. The market comes into let's say now you want to trade maybe the OTE. Then you're gonna look at this from this leg low to this leg high. You want the market to move to come to an OTE. You look this, do this. Now the market came into the OTE level. Then you buy at the OTE level. Then you keep the market up. Okay, guys. Now for our first example, we're going to use the US 100 on the daily time frame. What you are looking for is you are looking for the premium and the discount market to see whether we're going to be buying or selling the market. Right? If you look at here, we know that we are in a downtrend because we have this market structure shift here. We have this market structure shift. This market structure shift here tells us that the market is bearish, and we know that we're in a bearish movement because after this break of structure here, the market came and filled this volume imbalance before going down. So it created a low and it broke this low again. So this tells us that we are in a downtrend. So we're looking to sell. So we're looking for a premium market so that we can sell. So now if you look at this, we have this high here, we have this high, and we have this low here. We have this low here. What do you look for? Now we are looking for the market to come back into the premium, meaning above this 0.5% so that we can sell. Do we have any PD array in this premium market? We have this fair value gap here. We have this fair value gap. So what we're looking for is we're looking for the market to come into this fair value gap before selling again. The market came into the fair value gap. Then if you want to refine your entry beta, we talked about the 50% of the fair value gap, which is a consequence encroachment of the fair value gap. Right? You sell here and you target here. The one other important aspect of premium and discount is for us to gauge on our risk to reward ratio. If you look at this, if you want to sell here, and you say we are selling in premium, if you sell here and you target here, and you put your stop loss here, you look at your risk to reward is 1, right? Then but the more you move into the discount, into the premium market, the more you move into the premium market, the more your risk to reward ratio increases, right? So now to increase, we look at this fair value gap and we look at the 50% of the fair value gap and say that's where we are going to sell, and we target here. So we increased our risk to reward ratio. Right now, let's wait for our next example. Let's go to the 15 minutes. Okay, guys, for our next example, we're on the 15 minutes, still on the US 100. What you have is you have this swing high and this swing low. So you plot your fib from this swing high to this swing low, and we have our 0.5% here, our equilibrium. Then you look into the premium market before we sell it. We say, where do we have what do we have in here? We have a fair value gap. Which PDR rate do we have in here? We have a fair value gap here, and you take your buy position, not buy position, your sell position, and you put it at the 50% of the fair value gap, and you target these lows, and you hide your stop loss just above this high. So here the market didn't get to here, but I like to think that whenever the market came to this down candle here, you took your partials to just to keep your order safe. You took your partial and you put your all just below the fair value gap. Just want to use two examples. I don't make this video as lengthy as it would be with many examples. So my advice to you is to go into the charts and look for as many examples as you can find, and attempt to do this on your own before you'll see how many times this happens, right? If you have made it this far, please consider subscribing and commenting to this video. See you next time.